Recording in progress.
Hello.
How you doing?
All right. Okay. I'm trying to convince it to share my screen. Oh, here it goes. Okay. Beautiful. All right. It's all set now. All right. So great. So now this week we're going to focus our attention on options. Not that we haven't already started talking about options, but now we can look at it in a more intensive way and learn more of the key features of them, look at some strategies, trading strategies in particular. Yeah.
Can we go over the homework for a moment?
Oh,
Do we
which
have time?
one?
The one that we
Oh,
just did. I had a lot of difficulty
oh,
with
okay.
that, with the template.
Yes. Oh,
Not
was it?
downloading it, just doing it.
Oh, okay. Yeah, let me open that up real fast.
Also, I mean, are these homeworks graded? I don't know, like
Oh, they
how we're
are.
doing.
Yeah. No, I haven't had a chance. I will though. Don't you worry. I'll grade them. But no, so far I haven't had a chance to do them, but
Okay.
I'll knock them off probably this weekend or next weekend. So let's take a look at these. So so here's the template. And so what you were trying to do is fill in the cash flows. Now this is, oh, sorry, this is the interest rate swap. So you've got fixed rate cash flows. So if you see, let's see. Oh, all right, go ahead, send it to me. You've got a fixed rate coupon bond. A net notional is $1 million. The coupon rate is 3%. The coupon is 30,000. Now with a bond, a fixed rate bond, the cash flows are going to be equal to the coupon every year except for the last year. Oops.
Right. The last year is the notional plus the coupon rate.
That's right.
Right. Okay. With you there.
So this is our coupon and notional. All right. So it's just like having a regular bond. Now, the floating rate no cash flows, you only know what one is at this point in time. You only have know what's coming next. So you're going to put in the coupon, but you're also going to add to it the notional. Now, it's not that you're getting your money back in 1 year, but on that date, because the coupon's been reset to match the current level of LIBOR, it means that the bond itself will have a market price equal to the notional value on that date only. Okay, so in other words, the idea here with bonds is that when the market rate of interest exactly matches the coupon rate, the bond's price will be exactly equal to the notional principal.
Yeah.
So we only really need to consider this cash flow with the floating rate note because we don't know what the rest of them will be. Okay. But here we know that we'll be getting a coupon and we'll own a bond, which is guaranteed to be worth $1 million because of the way the interest payments are structured. Now, the discount factors, remember, we're assuming continuous compounding. And it looks like this should be here. Let's go back to the questions. I think that is in here. Yeah, you can have to again. It's fine. It doesn't have to be exactly a week later. Oh, here it is. Yes, you were supposed to get the LIBOR from here. Okay, so we'll put that in 2%. You just get so much crap open here. Here it is, 2.
Yep.
Actually, I think it's possible to just physically copy and paste these. Oh, maybe not. It doesn't seem to want to work. Oh, yes, it does. It's just the font looks strange. And so now the discount factors, because these are continuously compounded rates of interest, what you're going to do is put equals EXP for E, and your exponent will be negative the time and multiply that by the interest rate. And so you're gonna get a number which is less than 1.
Right.
I'm gonna have to change the formatting a little here. I'm gonna show it to 4 places, and then you can drag it down here. And so, the present value of the fixed rate bonds cash flows are the product of the individual year's cash flows times this discount factor. And then the same thing is true here. You just simply discount these cash flows. And, oh wait, what happened there? I think I must have done something wrong. Okay, now here I'm going to add these up. In both cases, you're adding these up. So you don't really need a sum there. So anyway, as of this point in time, the value of the fixed rate bond is greater than the floating rate bond. So if you're the fixed rate payer, that means you are short the fixed rate bond and you're behind. Okay, you're down 68, according to this, 68.
Yeah.
67. That's simply the difference.
That only counts for the 6 months, right? So we need to understand what lines 7, 8, and 9 and 10 would ultimately be, right? Because as it gets to 3%, I mean, that should basically even out because the fixed rate of the bond is 3%. So now we're saying the floating rate is 3%, so it should be canceled out at 4.5 or 5 years.
Well, no, not in this case because it's 2% now, but this bond is tied to the coupon rate when we started out of 1.75%.
Yeah.
So what happens is these rates can change every day, and so the discount factors can change. These numbers don't change.
Okay.
This number can change, but not the $1 million part, but the cash flows, because that's tied to last year's LIBOR rate.
Oh, okay. I was trying to solve for. I thought we needed to solve for the fixed rate note of cash flows for each of the subsequent years.
No, the way it's structured
Oh.
is that, yeah, this is.
I made it way harder on myself.
Yeah, this is all you had to do.
Oh my God.
And then it's filling in the rest. Now, the others are very similar. I mean, except here you've got the cash flows. You've got 2 different sets of interest rates. You're going to calculate the present values. And same thing, you're going to get 2 separate bonds here, one denominated in dollars, one in pounds.
And they
so
would
when you add them
cancel
up,
each other out.
right. You'll know which is more valuable because
Okay.
you'll have the 2 prices.
So feel free to disregard the email that I sent you last night that has the homework in it.
Oh, are you going to try it again?
Well, I mean, I had it, but I thought that I wasn't. I thought I needed to get every year's worth of
I
cash
see.
flow, and it wasn't making sense because
Right,
they have to cancel
That's
out.
right. Mm-hmm. So,
Okay.
all right. Okay.
Thank you.
All right. You're welcome.
That's super helpful.
Great. Okay. So yeah, I'm going to, I will be correcting these. It just hasn't happened yet, but I will. And so that's.
Don't correct them too soon, so I could send you the homework from yesterday.
Oh, all right. Okay. All right. So let me just get this out of here. Now, options, tonight, we actually, there is a template, if you notice, for this week's assignment, but it's a very different kind of template because it's just a set of what the options payoffs would be under different scenarios. So if you look at the first session, I've actually got 2 documents tonight. We've got session 4 and session 4 appendix, I called it. The appendix is where we have all the discussion about trading strategies. In the first part, we're going to be looking at the features of the options themselves. Now, at some point, we're going to focus all our attention on pricing them, but right now we're still learning the features of these options. And since it's such a complex product, that means that it's going to take a few weeks just to get through all of this. So some of this we've already seen. We're looking at the basic properties, how to determine the payoff of an option, how to calculate the profits and losses, and then some basic option strategies. Okay, so we'll start by reminding ourselves that an option is a derivative security, which gives us the right to but not the obligation to buy or sell an asset in the future at a price that's agreed on today.
Hey, just a
Yes.
heads up, there is no template in the contents.
Oh, no, really? Oh, Christ.
Yeah, it's just the session and then the assignment. And the assignment says fill in the template, but there's no template in there.
I'm glad you told me that. My God. All right, let me go get it in there real fast before I forget. Oh, that reminds me, I've got this stupid thing here. I have McAfee for my virus checker, and it's so like over aggressive that certain websites, I can't go to them unless I turn off the VPN feature. So I have to turn this off in order to go. For some reason, home.nyu.edu does not work when that thing is on. All right, let me get that. This will only take. All right. Boy. So we'll go to Brightspace, and then this is week 4.
And we should be sending to your Alan.Anderson email address, correct?
It doesn't matter.
It doesn't matter? Okay.
Yeah. You can send it to my NYU account or my personal. I do this all the time with all my schools because sometimes there are restrictions on what we can do with the school account. You never know what is and is not allowed. So, like, here's a perfect example of what I mean. I often send an email to the entire class. So I need to have all the email addresses in a spreadsheet. And some of the school accounts that I have, if I try to take a list of email addresses from my spreadsheet, it doesn't understand how to send a copy to everyone. It's just, I don't understand how that's possible, but that's what I've discovered. So, yeah, you're right. It's not here. So I'll just take care of that right now. Let's see. It's a good thing you noticed that. Here we go. Assignment 4 template. Perfect. And so you're saying you can open it up. In the past, we had all kinds of trouble getting at Excel files. Did you get it directly off of here, or did you get it from my email?
You're talking to me.
Yeah.
I didn't get the template. It's just not in here.
No, I don't mean this one from the swap template.
Oh, I got for week 3, I got it in here.
Oh, it did
But
work.
you also
Okay.
emailed it to us as well.
Yeah, because it was making me nervous the way it was acting. So yeah, I'm very distrustful of technology. I always assume it's going to fail me, and I'm often right. So it's you never know what to expect. So all right, anyway, so we can get back. So the assignment template is there, and if you look at it carefully, you'll see that it's got a lot of labels. And it'll make no sense to you until we get to that part of the chapter. But what you're seeing here is you've got an option with a specific, whether it tells you if it's a call or a put, whether you're buying it or selling it, and it gives you the strike price. And what you're seeing here with S is different possible stock prices on that date that it matures. And then what you're doing is filling in the profits. Actually, in this one, it's the payoffs. And then here we'll have the profits and losses. And once that's done, we can establish all these different trading strategies, which there's quite a few to choose from. And so these are some of the basic ones. And we'll be seeing what these are all about and why we might want to use them. So it looks like a lot, but once you get the hang of it, you'll see it's very straightforward. Okay. And then you get a chance to practice with Excel graphs, which is kind of nice. All right. So let's see. Oh, is there oh, okay, good. All right. So what you missed is that we realized that the assignment template wasn't there. It's there now. And we had went over very briefly last week's assignment in Excel. And I was just saying how we're starting up tonight in session 4, where we'll have our whole night will be all about options. Okay. Now I just realized I didn't bring a drink in here with me. I'll be back in 1 second because this is very thirsty business. So I'll be right back. All right. Now we can continue. Okay. So yes, so an option is a derivatives. We already know how that works. So just a few reviews of some of the key features. So the option, by the way, I forgot to mention here, in a lot of ways, an option is like a forward contract that you have the right to walk away from. Because it also, in both cases, you're locking in the price of an asset that you want to either buy or sell in the future. But here, there's no obligation. The main difference between the two is that you're allowed to change your mind with the option. You're never required to do anything, but you have to pay for that privilege. Okay, so in other words, there's no such thing as a price with a forward contract as such. You don't buy the contract, you enter into it. It's an agreement. With an option, you are actually buying it. And if you never use it, well, then you just lose the money you paid for it. Like in a lot of ways, it's like an insurance policy. If you buy an insurance policy and you never need it, you still have to pay the premiums. Okay, you don't get your money back because you never crashed your car, for example. All right, so anyway, the underlying is the asset that you're allowed to buy or sell. And it's the options have an interesting history. In the early days of option trading in the United States in the early 70s, all they had available was stock options. And even then, not very many of them. In fact, when they started trading on the Chicago Board Options Exchange in 1973, I think if I remember correctly, there were 8 options to choose from. Okay, well, things have changed since then. But those are the early days when people were still learning about options and understanding what they were for and why they could be useful. So it didn't take long before the word got around that these are very powerful securities. And so the trading volume went up very quickly. And in small stages, new types of options were introduced. For example, in 1976, we had the first introduction of currency options. And then 1979, interest rate options started being introduced. And then as the years went by, more and more of these different options became available. And then, what happens is when new derivatives are introduced to the market is some of them prove to be very popular and some of them do not. In fact, there's a lot of derivatives that have been introduced over the years that no longer exist because there really wasn't a need for them. So the market decides which one of these should survive, basically. So the ones that we see heavily traded today are, like if you see here, we've got interest rate options, we have currency options, we have equity options, equity indexes like the S&P 500, precious metals like gold and silver, and of course, I think we've already mentioned this one, futures options, where instead of having the right, let's say, to buy gold in 6 months, instead you have the right to enter into a futures contract on gold in 6 months, where the price at which you enter into that contract is settled today with using the option. Now, this proved to be such a brilliant idea that at this point in time, most options in the market are actually futures options, because the beauty of these options is that you never actually have to buy or sell the asset itself in order to make a profit. Okay. With the gold options, you do have to go through the formality of buying the gold and selling it, and et cetera, et cetera. Not so here. You can enter into a futures contract, offset it, collect your profits, and just be done with the whole thing. So that proved to be a huge deal. Now, there's a lot of other options as well, things that are kind of bizarre, but you can see why somebody might want an option on the temperature, for example. Imagine you're running a ski resort, and the worst thing in the world that can happen to you is that it's too warm and nobody can ski. So you can get an option which acts as an insurance policy, which means you'll be getting a payoff if the temperature is too warm. Now, the reason why this is possible is because here's one of the unique features about options, which you don't see with the others. I think we've already mentioned this, that forward contracts and swaps are traded in the over-the-counter market. Actually, I shouldn't say traded. They're not really traded. They're negotiated in the over-the-counter market, which means directly between counterparties. You're basically just negotiating terms and conditions. And but the advantage of that is that you can customize these any way you like. All right. If I need a forward contract on some very obscure currency that doesn't trade a whole lot in the world, it doesn't matter. If I can find somebody who's willing to sell it to me, I'm in business. As we know, futures contracts, on the other hand, are completely standardized, only available through exchanges. Options, on the other hand, can be bought in either market, in either the over-the-counter market or through exchanges. And that makes it, that's another way in which options are unique. So the ones that you see here that seem a little strange, like options on the temperature, those are negotiated in the over-the-counter market because they're very, very specialized. They're designed for a single user's needs. Whereas an option, let's say in gold futures contracts, is going to be very liquid. There's going to be a lot of trading volume, and something like that would be only available through an exchange like the Chicago Mercantile Exchange. Especially because, like I said, futures contracts can only be traded through exchanges. So options on futures, it stands to reason, could only be negotiated through an exchange. All right, and then we've seen the website for the CME, Chicago Mercantile Exchange. They have all of this stuff on there. Anything you want, they have it. So in other words, if you wanted to go in there and say, well, listen, what kind of futures options do you have? I'm sure, yeah, they anything you can think of, they have it.
You can actually buy options through here, though, can you? This
Oh,
isn't a
absolutely.
platform for that. Oh, you can.
Oh, yes, no, but I mean, the thing is, it's not like having
It's not a brokerage.
No, I don't think so. I think what happens is if you have, let's say, a Charles Schwab account and you say, listen, I want gold futures options. I'm thinking that, yeah, that's a good question. I don't think I can go in here and say, please, Chicago Mercantile Exchange, directly sell me one of these products. I think you do have to go through a broker.
Yeah.
Because they,
account synced to your login, I would imagine.
Yeah, and they, the thing is too, they want to make sure that nobody starts getting involved with these contracts who shouldn't be playing around with these because they're so horribly risky. So I'm guessing that a broker would have to get involved here, but this is where they would actually buy the contracts. So, oh, they do have a nice little chart here. I didn't see this before. So they broke it down by asset classes, and of course, this is one of our latest additions, the cryptocurrencies. And so they've got it broken down into option and the underlying futures contract. Also, this is a new trend too. It used to be that the minimum investment was quite large. Lately, they've added these other mini contracts. So smaller investors can buy contracts without the price being astronomical. So, and you can see all kinds of possibilities here: copper, gold, silver, agricultural. Actually, agricultural futures have been around quite a while. It's really only options that are fairly new. And you can imagine why. I mean, up until really the early 20th century, most countries were primarily based on agriculture. Their economies were agriculture driven. So there was always a demand for hedging the risk of being involved in agriculture, meaning farmers needed some way to control the risk that the prices of their products would go up or down. And so these contracts were available for that purpose. And then we have natural gas up here. We have currencies, interest rates. Now, the interesting thing about interest rates is even futures contracts and interest rates are cash settled because there's nothing that can be delivered. You do get that sometimes with some of these products or equity indexes. They usually are cash settled. You don't actually have to take delivery of a bunch of stocks. But anyway, so it's all here if you want it. Now, the strike price or exercise price is the price at which you can buy or sell. And at any given time, there's likely to be a large number of strike prices, depending on the asset, how popular it is. The maturity, now that's the time frame until the option expires. Options have a finite lifetime. Very few of them go out more than a year. That's not, it's very rare. They do exist. Options that last 2, maybe 3 years. It's very unusual because most of the time, you're looking to the future, you're trying to hedge an exposure that's going to take place in the future. And you don't really know what's going to happen in 2 or 3 years. So you can see why hedging 2 or 3 years down the road could become problematic. So now the call is the one that gives you the right to buy, and the put is the one that gives you the right to sell. And also within these categories, options are typically either European style, which means you have to wait till the maturity date to make a decision whether or not to buy or sell the underlying asset. Whereas the American style options, you have every single day until the maturity date, you can decide, do I want to exercise or not? So while the American ones are more powerful, they're certainly more expensive. Now, with all that being said, there are other options that are much more complicated than this. These are the standard ones. They're sometimes called plain vanilla. And most of the time, this is what people are buying or selling. But for certain applications, there are other options that might make more sense. These other ones are collectively known as exotic options. Now, what makes exotic options unusual is that I only have a few examples here. This is something you could spend a whole class just going over exotic options because there's so many of them. But what makes them different, usually, not always, is that let's say that you've got a European call option, okay? And so what happens is, let's say you decide to buy a European call option on gold. But the strike is $1,500, let's say. So what happens is, let's say this chart represents the evolution of the gold price over time. Oh, we have some more chats. I almost missed them. Oh, what factors? Well, that's a very good question. Basically, the strike price has a direct impact on the cost of your position. So it depends on what you're trying to accomplish. If you are gambling, let's say if you're speculating, you may want to consider buying a strike price such that the price of the option is very low. Let's say, for example, let's go back to finance.yahoo.com. I take a look at options that are available on, let's say, Apple stock. Until you'll see that they do have today's option prices. That's as far as it goes. You can't get any more than that without paying for it. But if you look at, let's say, the calls, the current price of Apple is $209.68. And so you can see, let's say I decide to buy one with a strike price of 200. That's going to cost me $10.05. Now, that means that if the price goes up by $10, I'm going to double my money, basically. All right, we'll see why that is the case in a bit when we start introducing payoffs. It's not that terribly heavily leveraged. It's small gains in Apple
I'm so
stock.
sorry. I missed that. You said if the price goes up by $10, then what?
Yeah, imagine the stock price goes up by $10 tomorrow. That goes right into your pocket. And so that means your $10 investment now is worth 20. Okay, now we'll explain this in more detail when we get to that part of the chapter. But the thing is, if you look up here, let's say you buy this one that's it's got a strike of 225. It's only selling for 4 cents because you only make money if the price goes up from here to 225. And there's a fairly low probability of that happening. Okay. So when you buy something like this, though, here's the thing. If it does go up to, let's say, 230, that's that's not a huge increase. It's 15%. You're basically making $5 on a 4 cents investment. So what kind of rate of return is that? That's like many thousands of percentage points. So you're basically given the opportunity to introduce or give yourself a lot of leverage because you have a very small investment with a very large profit potential. So a low strike price, or I shouldn't say a low strike, a strike with a low price attached to it. If you're speculating, that gives you an opportunity to earn a huge rate of return, even for relatively small changes in the price of the stock. But if you're hedging, there might be a specific reason why you prefer to have it at, let's say, what happened here? I lost my place. Oh, there it is. Okay, like there might be some. Oh, something's wrong with this thing. It's got all the strikes. Why is it doing that? Oh, I must have clicked something that I shouldn't have. Oh, wait, there it goes. No. Sorry, I didn't know this could happen. Hold on 1 second. Let me go back there again. All right, here we go. So let's say that if you're just hedging, you're not speculating, you're hedging. And there's a really good reason you want to lock in a price of $220. So then you might just buy the 220 strike call, regardless of what the cost is, because there's some really good reason why you want to make sure that the price you're paying for this asset does not go above 220. Because when you buy it at 220 like this, no matter what the market price is, you are being given the right to buy it for 220. So for hedging purposes, there's going to be other considerations depending on what kind of asset it is and what kind of business you're in and what you plan on doing with it. But for speculative purposes, the ones with the low strikes here are very expensive, but the option, the price of the stock is already above those levels. So already you're making some money. The question is whether it's worth this price. So for just plain straight ahead gambling, these low cost options give you the potential to earn a gigantic rate of return, even with a relatively small change in the price of the stock. So we're going to see some examples later on where this is exactly what happens. And that's one of the reasons why they're so popular, because if I buy the stock now, let's say it's $200. If the price goes up $20, I'm making 10%, which is great. But if that's $10 or $20 out of a $200 investment. Down here, with one of these options, let's say I buy the 200 strike call, the price is $10. That means that if the price of the stock goes up to 220, the value of the option will basically double from 10 to 20. So I've just made 50%, 100% with only a 10% increase in the price of the Apple stock. So there's a lot of leverage, or can be a lot of leverage with options. But anyway, where were we? Oh, yeah, here, okay, exotic options. This is what I was starting to say. This is what makes exotic options so unusual, but you can see why the value potentially could be very high, depending on what you're trying to accomplish. Let's say we have a standard European call option on gold with a strike of $1,500. So here's a chart showing the price of gold. And here's actually the horizontal axis is the price of gold. The vertical axis is simply dollars. So I have a strike price of 1,500. This is today. This is the maturity date of the option. And let's say the price moves around. This is the spot price of gold. And on, let's say the final day of trading, the price, we'll call it ST, is $1,600. Actually, I didn't draw that very well. Let me fix that. All right, that looks better. Okay. So on the final day of trading of this European option, the price ends up at 1,600, whereas my strike price is 1,500. So I've got what's called a payoff equal to the difference between the two, which means $100. So because it's a European option, the value depends 100% on this number compared to this number. The fact that the gold price bounced around like that has no bearing on its value. With an exotic option, though, what will happen is the path that the gold price follows can have an impact on the value of the option too. So, for example, we have something called an Asian option. And so what will happen with an Asian option like this, or at least this is one of the ways we can structure an Asian option. What's happening is that we choose certain dates in advance. Let's say we choose this date, we'll call it T1, T2, and let's say T3. So the payoff here is not the difference between these two numbers, like it would be for a European option. The price at this time and the here and here are averaged out. So what you're effectively doing with this European option is, Asian option is that it's as if you were calculating or hedging the average price of the gold during that time period. Okay, instead of hedging the price at time T, you're actually hedging the average price over that time interval. So the value depends greatly on the path followed by the gold price. So in another scenario where we also end up at 1,600, here we're going to have a nice little payoff because the average price is above 1,500. But if instead something like this happens,
Does the price fluctuate from those different time periods in the Asian option? So between 1, 2, and 3,
Mhm.
is it just consistently at or above 1,600?
Well, see, the thing is, yeah, I mean, the payoff is not determined until the very last day of trading, typically. But it depends on how many dates you chose at which to observe the price of the gold. So you can figure out the market price of an Asian option before the maturity date, but it's a very complicated thing to do, and especially because we still don't know where we'll end up at the end. So Yeah,
Would it
the
be the same
value
for
of
the
the,
European one too? That you can, what was a, you said
oh,
that we could,
you can always calculate a market price, but this one is a lot messier because a lot of it depends on the, you see, because we're calculating the average as opposed to the final trading price. That average can change dramatically from one day to the next. And so yes, I mean, the Black-Scholes models we see can always give us a price for a European option, but it's not going to work for a case like this because we have to take into account multiple prices. And so that's why it's such a mess to calculate the prices of exotic options, because it depends on not just where does the price end up, but how did it get there? So yes, it can be done, but it's a lot messier. But anyway,
Either
but
way,
just
you're locked into this option, correct? Till
well,
maturity
that's
for
true.
eight for the
Yes, I
HE.
mean, yes, you can't walk away from this thing, but you could sell it to somebody else if you're not happy with it.
Well, I see
That's
here
always on
you
the
have
table.
and you mentioned a chooser option, so you can decide between a call and a put. Is that only when you first purchase or decide to?
That's right.
Yeah, whenever
When
you first buy it.
yeah, but well, usually what happens with a chooser option is you start out by saying, listen, it's March 13th. I want to buy a chooser option, and it'll say, they'll give you the right that, let's say on March 15th, you can decide if it's a call or a
Okay.
put. And then once you do that, you can't change it.
And is the term like, but you also get to decide the term length, so it doesn't have to be a year. It could be shorter term, or it has to be.
Oh, you can pick anything you want. That's
Okay,
right.
that's
That's
what I thought.
because these exotic options are being traded through the over-the-counter market. So you can design it any way you want and have any features you want. So what happens is you'll go to an investment bank, let's say Goldman Sachs, and say, listen, I need this option with these features. And they have a team of financial engineers will sit there and figure out how this thing will work. And then they'll figure out what price to charge you for it. So they
So because these are over the counter options, that couldn't there be a default on it?
yes, that's right.
Okay.
That's exactly right. And so you hope that the Goldman Sachs of the world won't go out of business, but you never know.
Oh, right. The housing crisis. They all
Yeah,
there was OTC bond options. And then when they
that's
Lehman Brothers
right.
defaults, you don't get paid on it.
That's right. That's exactly right. So anyway, but here, if you notice, even though we ended up with a final price of 1,600, depending on how far below the curve these the line these STs are, we may end up actually not having a payoff at all. We may end up losing money because the price, it's the average that matters. So no matter where it's not the final point that matters anymore. It's how did you get there? So, but usually these are used for hedging a stream of exposures where the timing may not be perfectly predictable. So like a European option is perfect if you know for a fact that on, let's say, April 1st, you're going to buy 100,000 British pounds. Perfect. You buy a European option that expires on April 1st and you're all set. But here, imagine that you're buying gold on a regular basis and you're not sure what dates we're going to be buying them. So we know that there'll be a lot of purchases, but it would be horribly expensive to buy a string of call options for each date that we might buy gold. So this is a good compromise where you're essentially hedging the average price risk over that time frame. But you can see things can go terribly wrong. You can end up actually losing money on something like this, but at the same time, though, you are getting coverage. You get some kind of protection. And if you're the buyer of the gold, the thing that worries you is that the price will go up. And so that's what happened up here. So here you would have had a fairly large payoff. Here you would have had either no payoff maybe, or you would have owed money to the counterparty. But this is the cost of hedging. You're trying to hedge a very strange exposure, and you have to be prepared to pay for it. So the others that I mentioned briefly are the chooser option. Yeah, I just thought that would sound like a lot of fun. You actually get I think they might have decided they should have maybe called it a chameleon option because you get to decide. It can change. So at some point you say, all right, I want this to be a call. I want this to be a put. So that, in my opinion, you probably are not hedging anything in particular. You're probably gambling and you're saying, listen, I can't be sure if the stock or gold or whatever it is going to go up or down, but give me a few weeks and I'll have a decision for you. Now, of course, this is going to be a lot more expensive than a plain vanilla call or put, but if this is what you want to do, this is what you want to do. So your strategy is to buy a chooser option that gives you the flexibility of deciding if it should be a call or a put. You wait for a while to see how market conditions go, and then you decide which one you want. And you can't change it back. No, they don't. Now, having said that, I'm sure that you could ask for an option where you can change your mind a couple of times, but that isn't a chooser option. That would be something different. Anything you can imagine, any wacky payoff feature you can imagine, you can get it if you're willing to pay for it. It's like a house. When you buy a new house, you can have anything you want if you're willing to pay for it. If you want to have 9 bedrooms, and that's your business, you can have it, but you just have to be prepared to pay for it. So a Bermudan option, what happens there is that instead of having to wait to the maturity date to exercise it, or be able to exercise it every single day, here instead there's a handful of dates on which you can make a decision. Yes, I want to exercise. No, I don't. So think of it as a hybrid between a European and an American option. Now, the scuttlebutt is that the name derives from the fact that Bermuda is in between Europe and America. Some of these names, nobody knows where they came from. Now, of course, if you look at a map, you'll see that Bermuda is way closer to America than Europe, but still, I guess it sounded like a fun name. And so this is what we still have. All right, the premium, the price that you have to pay to buy one of these options. So we saw a list. These are all premia. And by the way, you notice these are bid and ask prices, just like in the foreign currency markets. So as an investor, by the way, I can buy these options, but I can also sell them. And so these prices are there to reflect, like if I want to buy this option, I pay 110.05, but if I want to sell it, I only get 109.40. Okay, that's because it's a dealer market, and this is how the dealers make their money. So the relevant one for buying them is this one. The relevant one for selling them is this one. So why are we paying for this option, by the way? It's because of the fact that since we can walk away from an option, it has a maximum loss, which is the amount that you paid for it. And in principle, there's no maximum profit. In other words, in principle, you can make as much money, an unlimited amount of money. Okay. Like for example, what if I buy this one at 200 strike at $10.05, and then tomorrow Apple announces a computer that they're bringing out that can I don't know, it can transport us to the moon or something ridiculous like that. Some spectacular new product comes out and suddenly the price goes from 200 to 1,000 or something ridiculous. Well, all that's going into my pocket. There's no limit to how much I can make, but because I only paid $10.05 for this option, that's the maximum I can ever lose. Okay, so that's what we mean by limited loss potential with unlimited profit potential. Options are highly leveraged, meaning that a small change in the value of the asset can have a major impact on the price of the option. But it also goes both ways. For example, and depending on what we paid for this option, a 10% price increase in the price of gold could potentially increase the value of a call by 200%. But it can never cause us to lose more than 100%. So we're going to introduce the so-called payoff function to an option, here specifically the call option. So now what I'd like to do is use an example here to illustrate how this works. So imagine a scenario where an investor buys a call option on gold The strike price is 1,500 and it expires, let's say, next March the 1st. It's a European option, so the investor has to wait until next March 1st to decide whether or not to exercise the option. So imagine there's two different scenarios here. In scenario one, the market price of the gold on March 1st is $1,700 an ounce. Now you have the right to buy it for $1,500 an ounce. So of course you're going to do exactly that. So you use your option to buy the gold for 1,500. You then have the ability to immediately resell it in the market for 1,700. And the difference between the two, S is the spot price of the gold, X is the strike price. The difference between the two is $200. That is referred to as the options payoff. Okay. Now, on the other hand, what if the price had gone down? On March the 1st, instead, the market price has dropped to $1,400 an ounce. Now, nobody in the right mind is going to exercise their option to buy it for $1,500 when it's only worth $1,400 in the marketplace. So therefore, we simply allow it to expire. We do not exercise the option. That does mean, though, that we get a payoff of 0. Okay. So basically, that means, to summarize with a call option, it's either S minus X if S is strictly greater than X, or 0 if not. All right. In the first case, we exercise the option. In the second case, we do not. And so algebraically, it's common to write it like this. Meaning that it's the greater of the two, if you notice. It's never going to be negative. So that's why it's written that way. Max stands for maximum. So if S is greater than X, we have a payoff equal to S minus X, which is positive. Otherwise, we get nothing. Okay. So that's how call payoffs are determined. By the way, you hear these terms tossed about in the options markets. If this is in fact the case where we get a positive payoff, the option is said to be in the money. If S is exactly equal to X, we say the option is at the money. And if S is below X, we say the option is out of the money. Yeah, you will hear this terminology as we go along, because in fact, the Wall Street has invented this new adjective called moneyness to describe whether the option is in the money, at the money, or out of the money. So if you see that word moneyness, you'll know what that means. I'm not sure if it ever made its way into the dictionary, but that's what they call it on Wall Street. Now, here I've got a bunch of examples with graphs. Now, this is interesting. For the first time, we're going to see some graphs that illustrate how this works. We have a European call option on IBM stock that expires on September 1st. The strike price is $50. The premium is $3. Okay, now, this is an assumption. I don't know how much it really sells for, but let's say it's $3. And so here's a table. Now, this table is meant to represent all the different stock prices we might encounter on September 1st, right? We don't know what it's going to be. These are some of the possibilities. The strike price is fixed at 50. So here we have the payoffs. As long as the stock price is not above 50, the payoff will simply be 0. This is where the option is not exercised. Once you get past the 50 hurdle, after that, if you notice, every time S goes up by $5, the payoff goes up by $5. And in fact, it's nothing but the difference between these two. So here the payoff is 0. Here the payoff is S minus X. And it's never negative, if you notice. It can't be because nobody, well, based on the assumption that nobody will exercise it when they should not. Okay, as long as the stock price is 50 or below, nobody will exercise it. The payoff will be 0. After that, every $5 increase in the stock price adds $5 to our payoff.
But if it doesn't go up and it expires, your profit would be a negative $3.
That's right. If you don't exercise it, that's going to come up next. Yes, the payoff, this is the payoff, but you're right. Then the $3 comes into play where the actual profit or loss is equal to the payoff minus what we paid for it. So yes, in the case that you don't exercise, you're actually losing the full $3 that you invested. So we'll get to that in a couple of minutes. Here, now this is the graph of what I just showed you. Now, if you notice, it's a flat line up to $50, which is the strike price. So it's 0 up to that point. After that, you notice how I wrote the word slope equals 1 to indicate that every $1 increase in the stock price adds $1 to our payoff. Okay. And it kind of looks like a hockey stick, doesn't it? Or at least the goalie's stick. And you notice it goes up forever. There's no upside limit on how large our payoff can be. But yes, we did take into account, we have to take into account now the $3 that we paid for this. So with the $3, well, first things first, the profit or loss, as the case may be, equals the payoff minus the premium. So from that premium, we have to subtract the premium from our payoff to come up with a profit. So the profit, while we can lose money, the maximum we can lose is just the price we paid for the option. So the premium for the call, we're going to call it C. So the maximum loss is, I'll call it minus C dollars, to indicate that we have a 0 payoff, and therefore our total loss is the call premium. Okay, and that in turn represents 100% of our investment. Okay, and then what we're going to see here is that this chart is the same as the other one, except the $3 for the call price are here. So the profit, if you notice, is the payoff minus the call premium. So all I've done is subtracted $3 from each of the payoffs. So because of that, the graph has the exact same shape. It's just been shifted down by $3. And so you can see that now it's flat, and then the slope is 1 after that. We have the 50 strike is here, and then we have a break-even point, which is $53, which means the price has to go up $3 to cover the cost of the premium. After that, it's all profit. Okay, we like that, right? All profit. So that's the payoff. That's the profit or loss to the call option. Now with the puts, of course, this all works backwards because we have the right to sell something. So whereas with the call, we benefit from a rising stock price. With a put, it's the other way around. So the payoff, if you notice, is written differently. Instead of the max of S minus X and 0, it becomes the max of X minus S and 0. Because now, as S falls, the payoff rather increases. That's why it's written this way. X is a fixed constant, so as we experience a falling stock price, the payoff will get bigger. Okay, so remember, when you buy a put, you're doing one of two things. You're hedging the risk of the price going down, or else you're speculating on the price going down. In the one case, you're trying to avoid the price going down. In the other case, you're hoping that it goes down. Okay, now here's the interesting thing. What do you suppose that? Oh, and by the way, comparably to the call, the profits though equal the payoff minus the put price or premium. Okay, so it's always the payoff minus the premium that gives us our profits or losses. Now, the terminology, the definition of in and out of in and out of the money are reversed from before. Okay, at the money doesn't change, but the definition of in and out of the money is reversed for calls and puts. Okay, so remember, in the money just means we have a positive payoff. Out of the money means we have a negative payoff. At the money simply means we have a payoff of 0. All right. So now you're probably wondering, what about those graphs? What would they look like for a put? So this time around, we have an American call or put rather on IBM stock. It expires on September 1st. So in other words, nothing's changed except that it's a put. But if you notice, this time the premium is only $2. Now, we'll see later on when we start talking about the Black-Scholes model that it's normal for calls to be more expensive than puts. Okay. We'll see why at that time. But here's the payoff. Here's the calculations for the payoffs. And what's different here is that we have maximum of X minus S and 0. So the not exercised part is down here. Exercise is down here. And if you notice, it's when the stock goes down, like we see here, that the payoff is going up. When the stock price goes up, the payoff hits 0 and it never goes up again. Okay. So with all that being said, this is the new graph. So I drew in a little picture of the call payoff diagram to remind you what that one looked like. So you can see the two of them are simply mirror images of each other from left to right. So in other words, when you have a call versus a put, you're reversing the image from left to right. If you notice up here, the slope is -1 because what's happening here is that as the stock price goes up, or actually what I should say is as falls, the payoff rises and vice versa. All right. And of course, the slope is 0. And also keep in mind too, that this is the out of the money region. This is abbreviated often OTM. And this is the in the money region. And the X itself is the at the money region. Interesting. Huh. Now, by the way, I do want to mention one little technical detail here. One way in which the two are different from each other, I'll just throw this in here right now. There is an upside limit to the payoff of a put equal to the strike price. Okay, so here's why. If you look at this, now,
0.
it's not exactly. Yes, you see, the problem here is that the price of the stock can't be negative. So that means that unlike the call where the profit or the payoff can go up and up and up forever, if the stock price keeps falling, it can't go below zero. And at that point, I reach my maximum payoff, which is equal to the strike price of $50. Okay, so in that way, the two are not exactly the same. Okay, but other than that, they're just the reverse of each other, like mirror images of each other. Okay, so that's kind of important detail, but the reality is how you're not likely to get into that neighborhood anyway, where the stock price is zero or that kind of thing. Now let's take into account the premium of the put, $2. We subtract 2 from all the payoffs, and so now that, as we would expect from seeing what we had before, that I've taken the payoff diagram for the put and I've subtracted $2 from it, it gets shifted down by $2. As you can see, the shaded region is my maximum loss, which equals the put price. And then there's a break-even point of $48 where I have to cover the cost of the put. And then after that, it's all profit. So that means the maximum profit is $48. The maximum payoff is 50. The maximum profit is 48. Okay. Now, oh yeah, I guess this is the discussion about how options can be traded through the over-the-counter market or through exchanges. We've already covered that. Now, here's the interesting part. Remember when we were dealing with forward contracts, you had the right to either agree to buy or sell something in the future. And if you're the buyer, you're said to have a long forward position. If you're the seller, you have the short forward position. Same thing is true with the futures markets. With options, you can actually take a short position in an option, which means that in effect, you're selling something that you don't own. So a trader or any market participant, right? Let's say a market participant can take a short position in an option. So it's known as writing an option. So I can, for example, I can agree to buy the right to buy IBM stock at a strike price of 50 with expiration date of March 1st. To a counterparty, and in exchange for the premium. So I'm putting myself in the reverse position. I'm saying, listen, instead of me buying this option and having the right to buy IBM stock, I can do the reverse. I can say, I'm going to collect a premium, and you then have the right to decide if you want to buy IBM stock. And if you decide to buy it, I'm the one who has to deliver it to you. So I can either be the buyer or the seller of these options. So just like with forward contracts, I can be in the position to sell or buy. The same thing is true here. Now, it turns out, though, that selling options is horrendously risky. So these are some of the drawbacks, as we'll see in a minute. Writing or selling an option is extremely risky because the seller or writer has limited profit potentials, unlimited loss potential. Everything's working backwards, okay? Because I'm giving the right to somebody else to decide whether they want to buy the IBM stock. So that means that they will exercise that right when it's profitable to do so, but that profit comes out of my pocket. So in a way, you could think of this as being in the same position, I guess, as an insurance company, because you're collecting premiums from the insurance company, I mean, it's from the customers. But when something goes wrong, you're the one who has to cover the losses. When you think about it, it isn't really very different than what an insurance company is doing. They're collecting all these premiums from all these different customers, and they're hoping that not too many customers have an accident or have their house burned down, because you're the one who has to cover that. So in fact, there do exist organizations called reinsurance companies for insurance companies who are nervous that they're overexposed to some type of risk, but they can't very well cancel their contracts. So they can go to a place like Swiss Re and say, listen, we insured all these houses in our area, but we would like to sell those to somebody else. And so the reinsurance company will buy them and take them off your hands and reduce your risk. So anyway, what we need to do now is consider the payoffs and the profits and losses to the option sellers or writers. And by the way, here's an interesting side note. As a trader, you can actually be a buyer and a seller at the exact same time. In other words, it's not the case that we have a different group of people who are buying and another group who are selling. The same market participants can both buy and sell. And in fact, that's the reason why we can create so many exotic trading strategies, as we'll see in the second part of this chapter, because of the ability to both buy and sell. Okay. So anyway, so the writer of an option faces limited potential gains and unlimited potential losses, but is the one who collects the premium. Okay, so like I said, it is comparable to the same position of an insurance company. Now, if you notice, the payoffs are just the negatives of the payoffs to the buyer. So the one on the right is the one we were just considering. The buyers have these payoffs. On the left, the sellers or writers have these payoffs. The only difference is that negative sign. And that's because between the buyer and the seller, the payoff has to add up to 0. If I have a payoff of 5, and I'm the buyer, the seller has a payoff of -5. They always add up to 0. So you may have heard this phrase in economics. It's called a zero-sum game, meaning the gains of one are the losses of the other. So they must add up to 0. Now, here's where it gets interesting. What about the profits and losses? Well, just like before, sort of, because you've got a payoff here, but now instead of paying the premium, you're collecting it. So you've got your payoff plus your premium. And so here we have the profits and losses of the call and the put writers. So basically, everything's just been multiplied by -1. Now, you're probably wondering, well, what does that do to our graphs? Okay, good question. So this is a chart that represents the position of the call writer. And you notice how everything's the same as before, except there's this negative sign. And so here, the option is in the money. They're the same payouts, but they're now negatives because they're coming out of our pocket. Otherwise, everything's the same. Here the option is exercised, and here it is not. Okay, this one is actually at the money, and these are out of the money. Okay. Now, let's look at the graph. Now, this is what it would look like from the perspective of the buyer. This is the seller's perspective. And if you notice, it's been flipped upside down. Okay, so the buyer has a certain position, the seller, it's reversed. So the diagram is now flipped from top to bottom. Okay, and you can see that if the stock price goes up, the seller or the writer is in a lot of trouble. Okay, because you can see there's no maximum loss. Oh my God. Now, when you take into account the premium, yes, go ahead.
So in this scenario, I mean, if you're the call writer, you're assuming that the stock will stay the same or go down, so
That's
that
what you're
your
hoping.
option is not exercised by the call buyer.
Right. Exactly.
Got it. And
Just
on the
like
flip
the
side,
insurance company.
with a put, you're assuming that the stock will stay the same or grow up,
Go up, yes.
And if it goes down, then you are obligated to buy the shares.
That's right, exactly, at an unfavorable price. So, that's right. So once you collect, now, of course, you did collect their premium, but it's $3. So that means up here, if the option is not exercised or if it finishes out of the money, that means you get to keep the premium and you're happy. But guess what? Once it gets past that point, every dollar that the price goes up is coming out of your pocket. So the break-even point is 53. After that, it's all losses. Now you're probably wondering, well, why would anybody put themselves in this position? Because they're probably combining it with another position that offsets much of that loss. You know, if you're just gonna just go out and sell options, you're asking for trouble. I mean, because the potential for losing is absolutely amazing. So almost without fail, this position would be held in combination with other positions. And the net effect would be that there's some risk, but not nearly as much as what you're seeing here. So we'll see some examples of this later on. In fact, not too far down the road here, we'll be seeing a strategy where you're buying and selling a call. The only difference between the two is the strike prices. So anyway, now with the put, look at that. Now, again, if you notice, the calculations are the same. This is where the option finishes in the money. This is at the money. And this is out of the money. So all the payoffs are negative because you're the writer. If the price goes down, the buyer is happy. You're not happy because all those payoffs are coming out of your pocket. And then here's the graph. It's just flipped upside down from the perspective of the buyer. Now, of course, you did collect a premium. So when we take that into account, you can see you have a maximum profit of $48. But you know, there's no, well, of course, as we mentioned earlier, the price of the stock can't go below zero. So there is some maximum loss, but it's a very large one. In fact, it's actually $48 here. Wow. Yes, go ahead.
So what if you were to be if you're a put writer and you set the put at a strike price where you're comfortable having to buy the stock at? So then you would have
Well,
made a premium and then you've gotten into a stock at an advantageous price that you think is advantageous.
yes, but in order to do that, the premium would be smaller. And so it'll be less profitable if it finishes out of the money. So if you look at the chart here from Apple stock, so what you're saying is you want to minimize the risk that you'll end up having a negative payoff. The only way to do that is to have to lower payoff. And if you have a lower payoff, a lower strike, I mean, you're going to end up with a smaller premium. So if you notice, like I've got it here at 50. Well, this is not the same option, but you can see as the strike keeps falling with puts, the premium goes down too. So it's a trade-off between risk and return. Just like when you decide how much deductible to have on your insurance policy. You want a huge deductible, it's cheaper, but there's a lot more risk. And the same thing is true here when you decide what strike price to use.
But
Say for
time
your
is also a
position.
factor in it, isn't it?
Oh, yes, it is.
The
All other things
maturity date.
yes, as we get closer to the maturity date, and we'll see more of this later on. What will happen is the prices will adjust. And so on the actual final day of trading, the price of an option will exactly match its payoff. So we'll be discussing this in great detail in later chapters, but prior to that, like, let me just give you an example of this. Like right now, let's choose a different date. Let's pick April the 4th. Here we have an option with a strike of 200. Okay. Now, this stock is selling for 209.68. And so don't worry, we'll get back to this later on, but I just want to give you a quick, simple example of this. So let's draw a little graph. This is the payoff to a call option. So let's say I've decided to buy this $200 call option on Apple right here, this one. And the price they're charging me is $14.10. Now, here's the interesting thing. The market price of this option is only $9.68. I'm sorry, the stock price is 209.68. The strike is 200. Let's get back over here. So if this is an American style option, I could actually exercise it right now. And what would happen is my payoff is sorry. $9.68. But if you notice, and it's in the money, that means it's in the money by $9.68. Oh, why did that?
Gotta add in the amount you paid for it.
Right. What the hell? I don't know why it made that. I was trying to draw that line and it went horribly awry there. All right, I'll just delete it. Now remember, this is the payoff profile. So right now, if I had the right to exercise it, let's say this is an American option. I decide, you know what, I'm going to just exercise and collect $9.68. But I just paid $14.10 for this. Why is that? Why did I have to pay so much when the payoff is only $9.68? Well, the reason for that is because this option expires in about 3 weeks. So that means that between now and April 4th, let me add this here, maturity equals April 4th. There's a chance that Apple stock could continue to rise and increase my payoff. So we will introduce here, and again, this is getting a little ahead of ourselves. We'll see this again later, but if I were to create a new curve that represents not the payoff, but the market price of this option, it would look something like this. And that means I'm being asked to pay $14.10 for an option whose payoff at the moment is only $9.68. The difference between the two is called the time value of the option. which is 1410 minus 968, which is 442. Now that time value, like I said, represents the possibility, at least, that the price of the stock could continue to rise and therefore increase the payoff to the option. As time elapses, though, that market price will converge to the payoff. So let's say in a few weeks, say on 330, you see what's happening is that it's getting closer and closer to the payoff profile. The time value is shrinking. And then on the actual maturity date of April 4th, see if I can draw this in here so you can still see it. This blue line is the market price on April the 4th. That equals the payoff. So initially, when the option has a long time to maturity, it has a very high time value. As time elapses, that shrinks because the chances of there being a dramatic increase in Apple stock is shrinking as we get closer to the maturity date of the option. And on the final day of trading, the two are exactly the same. The market price will exactly match the payoff. So in this case, if the price never changes, on that day, I would expect to see the option trading for $9.68. So later on, we're going to see when we get way down the road, like in week 7 or whatever it is, we're going to see that there's a measure in the markets called theta, which represents the speed with which the option's time value shrinks as we get closer to the maturity date. Okay, so that'll be fun. We're going to implement that in a spreadsheet. And the formulas will knock your eyes out, but we'll have it all set up so it won't be too much of a pain. Anyway, so let's see where we leave off. Oh, right. So now we understand the payoffs and the profits and losses of the buyers and the writers of calls and puts. Okay. So that part is done. So now what we get to do in the second part of this chapter is introduce some basic trading strategies that you can create from these two basic or four, well, I guess you could call it 4 basic positions, being the owner of the call or the put and being the writer of the call and the put. The number of ways we can create or combine these into new positions is basically only limited by our imaginations when you come right down to it. There's so many ways we could put these together. It's almost like having Legos where you can put them together in all these elaborate structures from relatively simple building blocks. So let's jump ahead to that part. This will be the appendix now, as I've called it, where we're focusing all of our attention on strategies. All right, now this is just the tip of the iceberg, as you can probably imagine. We're going to have 2 basic types of strategies here. The first one is called spreads, and the second one is called combinations. And what separates the two is what kind of options are used to create them. So the spreads are the ones where we put together either several calls or several puts, or it doesn't have to be several, at least 2. All right. Anything goes except that both options or all the options are either calls or else they're all puts. We cannot mix or match. That's a separate type of strategy. So here we're looking at spreads, meaning that we are going to buy or sell some combination of calls or some combination of puts. The three we want to consider are the bull spread, the bear spread, and the butterfly spread. Now, the names sometimes help us understand what they're all about. In other words, what are we trying to accomplish here? Sometimes they don't help us at all. All right. But you'll see as we go along. So we'll start with the first one. Now we have this notion of the bull spread. And the bull spread, you know that in Wall Street, bullish means optimistic and bearish means pessimistic. And so the bull spread is set up to take advantage of price increases, but at a lower cost than just simply buying a call option. So what you're basically doing is you buy an option with a low strike price, and then you sell or write an option with a high strike price. But we have to make sure that they're identical in every other way. In other words, they both have the same maturity date and they both are written on the same asset. Otherwise, it's a different kind of strategy. So, by the way, if we use only calls, we know this is known as a bull call spread, as you can probably guess. And if we only use puts, it's known as a bull put spread. So we're going to consider the example of a bull call spread. Okay. So here we go. Now we're back to IBM again. We have a European call on IBM with a strike of 50. This is the same one we had before. Sells for $3. Now, keep in mind, let's go back to the Apple options. With a call, as the strike goes up, the premium or price of the option goes down. So here we're assuming that the 53 strike call on IBM, maturing on the same date, sells for only $2. Okay, so here's what we're going to do. We're going to buy the first one and write the second one. And then to keep them separate from each other, this one, the first option, we'll call it the call one. This is the price. This is the strike. This is the second one. The call, we'll call the premium C2, and the strike is X2. Great. So now here's the table. And here's the stock prices. So here's the one we bought. So just a quick reminder, X1 is $50. Sneak that in there. And the one on the right, the one that we sold or wrote, that's a strike of 53. So if you look carefully here, one on the left is out of the money here, in the money here. I'm sorry, at the money. Hold on one second. And here down here we have in the money. Since the strike is 50, you can see why the payoffs are 50 cents, $1, all the way up to $4. But at the same time, though, we sold this second one with a strike of 53. So it takes a while before we are in the money. So here we're at the money, in the money, and out of the money. So the last column is simply the sum of the second and the third columns. Now, if you look carefully at those numbers, you'll notice that they never go outside the range from $0 to $3. Because once we hit $3, you notice the option on the left gains 50 cents every time the stock price goes up 50 cents. But the one on the right loses 50 cents as well. So they exactly offset each other from that point on. The same thing is happening at the top. Oh, yes, go ahead. Oh, what happened to your sound?
I was mute.
Okay.
You're buying one call and you're selling another. So on slide 7, where it says the premium paid and then the premium paid, shouldn't be one premium received.
Well, that's a very good point. You're absolutely correct. Absolutely, you're right. I'm glad you noticed that. It always helps to have a second pair of eyes looking at anything you've written. Yeah, you're right, because I'm the buyer of the first strike and call, and I'm selling the second one.
So you're setting the call that you sell. So if the stock breaches that number, then you start to lose money.
No, actually, the losses. Let me show you the graph. These are the payoffs.
Yeah.
So what's happening is that when you get, if let's say the stock price goes past 53, that means you have all of the gains and losses from your two positions exactly offset each other, and you cannot profit from the price going above 53. That's it. You're capped to your payoff at $3. But you've also at the bottom have a minimum payoff of 0. So you're basically expecting the price to stay in this range. If you expected the stock price to go above 53, well, then you would simply buy the low strike call. There'd be no point in doing this. Sean Ali, do you have a question?
Okay, you could just make it easy and just say Shauna. That's fine.
Oh, okay.
So my question then would be, which one would be better to buy it like at the money, or out of the money? Like which one would be better?
Okay, so again, it really depends on your outlook about what's likely to happen in the markets, because the strike price that you choose, let's see, if we had different, let's see if I can put these on another graph. It would affect the range. Oh, why is it doing that? Let's say I pick, this is 50 and this is 53. Let's say I pick 50 and 55. All right, let me fix that. That's not what I want. So in other words, here the maximum payoff is 3. Here the maximum is 5. But this one is more expensive. So you see, this is the kind of choice that you have available to you. I can choose the two numbers that I want. If I'm willing to pay a higher price for this position, the upside potential is higher. So it really, like, if I really don't think there's any chance at all of the stock price going above 53, I might as well buy this one and pay $3. But if I think there's a real chance the price could go up to 55, then I'd probably be better off with this one. So it depends on what I expect to happen with the stock price in the future. It's really that, it's just a direct trade-off between the price and the potential earnings. Now, of course, I could be wrong. Remember, when you set these trading strategies, you're trying to make money. You're basically gambling. You're speculating that the price will go to a certain level and not past that.
So in a sense, it's subjective.
Yeah.
All right.
So yeah, you're gambling. I'm saying in the top, I'm not that optimistic about the stock price. In the bottom, I'm very optimistic about it. So I should be prepared to pay a higher price to capture that higher potential.
Is the objective to limit the losses? Because so if you buy a call and then you sell a corresponding call that has a higher strike price, you limit your upside potential, but you also limit your downside risk.
Right. And even more importantly, let's say you just bought the 50 strike call and let it go at that at a premium of, see, here's the difference. When you buy and sell, you're dramatically reducing the cost of your position. If you notice, in this case, I paid $3 for one call and I collected $2 for the other. So the total cost of this position is 3 minus 2 equals 1. But if I just buy this call, it costs $3. So that means that my potential rate of return is lower because I'm starting out by paying 3 times as much money for this position. So the rate of return to the same profit would be much lower. So if here I pay $3 and my profit is $1, that's 1 out of 3. But if over here, if I only paid $1 in the first place, my profit is $1, that's 100%. So this is the thinking that's going on behind the scenes. What rate of return can I squeeze out of this? So now keep in mind too, as a trader, I'm not going to buy one of these. I might buy 1,000 of them, let's say. So I can magnify my profits quite a bit. So but really what I'm focused on here is not the dollar profit, but the rate of return. That's what really separates the two. By lowering the cost of the bull spread, I can dramatically increase the rate of return. So these are both bull spreads, by the way. The difference being is what strikes did I use. So again, which one do you go with? There's all these choices, and of course, there's in principle an infinite number of bull spreads that I could set up. So the question is, which one should I go for? And of course, they'll all have a different. Yeah, go ahead.
So if it doesn't get to your strike price of 50 and it stays below 50 at, the maturity, you lose $1.
Correct. Whereas if you bought the call, you lose $3.
Yeah. Okay.
So in other words, you're capping your losses and your gains, and potentially increasing your rate of return because of the low cost of the position. But if the price goes up substantially, then you're going to be you're very upset with yourself because you lost all that upside potential when you set up a bull spread instead of simply buying the call in the first place. So that means I would describe this position as being cautiously optimistic about the stock. Cautiously,
you still
meaning
retain the gains that you did get
yes,
up until your sold strike price.
Exactly. Up to 53, the two positions are the same, except the bull spread is cheaper. After that, the call is a much better position to be in because all that upside potential you're still collecting on.
And is there a way that you can exit the spread early or then mature?
Yes, you can always sell. If you own options, you can always sell them to somebody else.
Yeah.
That is always on the table. If you're like, oh, for God's sakes, why did I do this? Not a problem. You can just sell it to somebody else. Even if you have to sell them into two different buyers, you can always offset your position by selling it to somebody else. And in fact, often we'll see later on that often that's a better strategy than exercising it early. But we'll have that discussion, in a later chapter. So, I mean, you can imagine, with these trading strategies, the number of possibilities is beyond belief. In fact, I think I remember a while back, I may have stuck it in a different folder. Maybe it was week 2. No, maybe I never posted it. I have this document. I guess it never made it in here. Basically, it is a document which has a nice summary of all these different trading strategies. Hold on a second. Let me go back to my files here. Let's see if I can find it. It might be fun to have access to this. All right, I think I know where to find it. Hold on a second. You'll see why I'm so excited about this in a second. uh, I don't want to waste too much time. I'm going to try one more place, and then if I can't find it, I'll look for it later. But it's this really interesting document. Well, this is specifically about the Philadelphia Stock Exchange. Um, it's like sometimes when you look for stuff, it's just unbelievable. I'm going to try this one more time. If I can't find it, it's going to have to wait. But it's just a small, PDF document. Maybe this is it. And it's basically a nice little summary of some of the most important option strategies that these guys published. And, in the past, I've posted it, and now I can't find the damn thing. No, I guess I was asking too much. All right, we'll get back to that later. All right, so anyway, so the uh, the next strategy that we want to look at. Oh, by the way, this graph takes into account the cost of the position, the dollar that we paid for it. So you can see the lower limit is $1. Sorry, the lower limit is -$1. The upper limit is a maximum of $2. So this is our bull spread. Okay. Now the bear spread is essentially just the reverse of this. You buy the higher strike call and you sell the lower strike call. And what is the point of that? So it's the same example, except here I'm buying the high strike and selling the low strike. And what'll end up happening here is that when you look at the graphs, so here's the payoffs. The one on the top is the bear spread. Now that's the payoffs only. So let me show you what it looks like when we take into account the premium. What's interesting about this one is that if you notice, I'm actually putting money in my pocket with this one. I'm paying $2 and I'm collecting $3. So I'm actually putting money in my pocket to take this position. Instead of paying for this position, I'm getting paid to set it up. How do you like that? Well, that's unusual. So, but on the other hand, that amount that I got paid, which is $1, represents the maximum or the best outcome that can happen here. So if you notice, I could potentially lose $2. So basically, as you can see, I'm hoping that the 50 strike option that I sold is never going to be exercised. That's essentially what I'm hoping for. So here again, I would describe this one as cautiously pessimistic. I expect the price to drop, but not a whole lot. Okay. So it caps my gains at 1, but it also caps my losses at 2. So, and you can see the break even is at $51. So this is the reverse. I mean, if you look carefully at them, you notice that you're flipping one upside down because these are the reverses of each other. You can make the case that the bear spread is the reverse, meaning that we're changing the signs of the bull spread. Okay, in other words, we're just simply reversing the directions. Where we were buying, now we're selling, and vice versa. Okay. Now the butterfly. Oh, go ahead, please.
So I see when I'm looking at slides 16, bear spread,
Yes.
you buy the option with the higher strike price and you sell the option with the lower strike price. But then
Right.
in example 18, you're selling the first call, which has a lower strike price, and you're buying the one oh okay, never mind. Sorry, I was looking at the
Yeah, no, it's right. Yeah.
I was looking at the premium.
Right. Yes, that's right. Those would be the reverse. The
Yep.
strike price and the premium always go in opposite directions with a call. All right. So now the butterfly spread is actually in a lot of ways the most interesting of these, because instead of effectively the first two, we think of these as, we sometimes hear them called directional bets, meaning you're betting on the direction of the market. Either you're betting that the price of the stocks will go up or down. The butterfly spread, well, we'll see in a minute, is something very unique. It's something you could not possibly accomplish with other types of derivative securities. What's happening with the butterfly spread is that we're introducing a third option. So in other words, we've got a 47 strike call on IBM, which sells for $5. We have a 50 strike, which we saw earlier, for $3. And a 53, which again we saw earlier. And now here's what's going to happen. We're going to buy this one. We're going to buy this one, and we're going to sell 2 of these. So you can see we're getting into some very deep territory here. Ooh, buy 1 of each of the low and the high strike calls, and we sell the 2 in the middle. So how much does this cost us? It's only going to cost us $1. But as you'll see in a minute, the motivation is very different than for the bull and the bear spread. So when I show you the graph, including the profits and losses, let me jump ahead a little. This is what it ends up looking like. Now the 50 is the strike in the middle. Think of that as X2. Here's X1. Here's X2. Why in the world would you set this up? What are we trying to do? Well, if you notice, we can make money whether the price goes up or down. But what we're hoping will happen is the profits are maximized if the price of the stock stays as close as possible to 50 X2. So what you're basically betting on here is that the price of the stock will stay very stable. That's a very different scenario. By the way, if you notice, our losses are capped at $1, the amount we paid for this position, but at the same time, though, the profits are capped at $2. So the bet here is that the price of the stock will stay very stable. We think that for whatever reason, the stock price will stay in the same neighborhood until the maturity date when we can exercise the options, and we'll end up hopefully with a profit of $2. Okay, so just as a quick aside, in the financial markets, we use the word volatility to represent how much an asset price changes over time.
When would
Okay,
you
so
enter into a butterfly spread?
let's say that here's an example I can think of. Let's say the company's selling along, and one day see, it's hard to think. It's easier to think of an example where the stock price will bounce around a lot. Let's say that for whatever reason, the markets are just happy. Things are going great in the world. There's hardly any turmoil. Things are just normal. And, there's no crises going on in the world, and the company is doing very well. They're not terribly exciting. They're just making a steady profit year in, year out. Then you might think about setting one of these up, because you're essentially saying, we don't expect the stock to fluctuate very much, at least not until these options mature. So you're betting against stock price fluctuating. And that means you expect let's say the earnings will be stable of this company. There's not going to be any major turmoil. There's no crises about to break out. There's no issues with the distributors. There's no strikes coming up. Things are looking pretty strong for the company, but they're not experiencing spectacular growth either. It's just a nice, steady company. Boring even, but profitable. Okay. So that might be a good time to set up something like this. Now, as it turns out, though, you may feel exactly the opposite. Let's say you have a company. Now, here's an example I thought of that I think will make the most sense. What if this is a pharmaceutical company, and they've applied for a patent on some major new drug? And this week, the FDA is going to announce either yes, we approve the drug, or no, we don't. If they approve the drug, the stock price will go through the roof. If they don't approve the drug, the price will go through the floor. That means we expect the market price to change dramatically. So what you can do is just reverse all these positions. In other words, where before you were buying, now you're selling, and vice versa. Then you'd end up with this position. And this is called the reverse butterfly spread. Now, if you notice here, what are we hoping will happen? We hope that the price either goes up significantly or down significantly. Now, this position costs us $3. And so if the price stays at 50, we have our maximum loss of $2. But if it goes up, the profit is capped at $1, but still, we don't really care which direction the stock price goes, as long as it moves substantially in one direction or the other. So we call this a bet on volatility, not on the direction, because we can profit either way, but on volatility. And this is something that's unique to the options markets, by the way. You could never accomplish the same thing with forward contracts or futures or swaps. Only options make this possible. So you can see the options make it possible for us to create all kinds of strategies that would be impossible with other types of securities. So this is one of the reasons why they're so popular. This flexibility that you get with your trading strategies.
So the implied volatility will help your position pretty much, right?
Yes, exactly. As long as the
Okay.
stock bounces around, whether it's up or down, we don't care. We'll make money. If it stays exactly where it is, we're going to lose money.
But it's a limited loss. It's only what you put in.
That's correct. But it's also an unlimited game. That's correct. So
But
now we're
I
going
don't
to see
understand
later
how
on.
it's unlimited if you make the most amount if it stays in the middle
No,
here.
there's no, no, it's limited. It's not unlimited. It's limited.
Okay.
Here you can see the max is $1. The minimum is minus $2.
Got it.
Now we're going to see something a little different later on when we get to the combinations, but this is a very relatively safe way of betting on volatility because yes, there's a maximum profit, but there's also very limited, severe limit to how much you can lose. So this is one way you can go ahead and bet on volatility in the markets. Now, by the way, interesting fun fact, the prices of all options will go up when there's more volatility in the market. So if you own an option, you are almost already indirectly betting on volatility anyway. But this way you're controlling the range of prices within which you'll make money. Okay. So yeah, we'll see later on why volatility is helpful to options. It's really not helpful to most securities, but here options directly benefit from volatility. So you have the reverse butterfly spread, which simply means we've sold the positions we previously bought and vice versa. Okay. So I thought you'd find that interesting. Now, the origin of the name butterfly, yeah, I don't know. But not sure if I think this looks like a butterfly, but that's the name that we're stuck with. Okay.
Are you for the reverse butterfly? Are you selling a call or are you selling a put?
Oh, they're all calls or they're all puts. So
Okay.
here we're assuming that they're all calls. But we
Right.
could have
So
just
you're
as easily
assuming stock goes down, right? If you sell puts,
right.
you assume that the stock's going up.
So so here we've got, remember before we bought the low and the high and sold the two in the middle. Now we're reversing that. We're buying the two in the middle and we're selling the high and the low.
But they're either all calls or all puts.
Yes, they're all calls or all puts. You can't mix or match them. Then you have a completely different situation.
Oh,
So
that's why it
this
doesn't matter if it goes up or down because they basically negate one another.
they will. Within certain ranges of prices, they'll exactly offset
Yeah.
each other. So when you see these flat
Offset.
regions to these,
Yes.
that means they're exactly offsetting each other. And that's by design. All right, now it's already 8 o'clock. All right, I'll tell you what, let's have our usual break here. I'm sure you're getting hungry. We'll knock it off for what, 20 minutes or so. We'll get some caffeine in our system or whatever you want to do. And then when we come back, we'll discuss combinations, which are also very interesting. And then after that, let me just see. Now, when we're done with the combinations, there's two more at the end that are a little different because instead of having all options, we actually combine options with the underlying asset. And then when all that's done, you will be able to do this assignment because you'll see what's happened here is essentially all the formulas you've been seeing in the slides. You'll be able to, you're basically just reproducing them here. And when you do that, ideally, you could also plot them in Excel. So let's say, for example, you just wanted to reproduce this one. The Excel command for maximum is literally just max. So you would fill it in. And then you could plot this. You have to be careful with this because the things you actually want are not in two consecutive columns. So what I did here to choose those was I held down the control key and now I can put insert. No, wait a minute. What happened here? Here it is, insert recommended charts. And usually this is probably your best, this one or that one. So this is what you'll be asked to do for basically all the positions we covered tonight. So it won't take as long as it looks because you can go into Excel, fill in these formulas, And then you, by selecting the stock price column and the payoff column or the profit or loss, you can create a graph like this one. And then that way you can visually see what's going on. Okay. So the thing is, there's a few at the end here we haven't done yet, but we'll be definitely done in time tonight. So you can do all of these positions in your spreadsheet. All right, well, anyway, let's do it. Let's come back. All right, it's already 5 after. Let's come back about 25 after. And then we will wrap up all these positions. We'll be looking at the combinations. And then the cases where we combine stocks with options. Okay, great. All right, so I'm going to pause this recording as usual so that there's no blank space. And I'll see you in a while. Okay. All right. Let's see. So anyway, we're done with the spreads. With the combinations, what's different is that you're going to have in each case at least one call and at least one put. So in other words, you have to have at least one of each for it to be considered a combination. So these are the four that we'll be considering, but realistically, the straddle is the most important one, and the other three are essentially variations of the straddle. They're not completely different. But when you see the straddle, you'll realize, wait a minute, this is really important. What you're going to see here is that we're going to buy a call and a put that are absolutely identical to each other, except for the fact that one is a call or a put. In other words, they have the same strike, the same maturity, the same asset. So you're probably wondering, why would we do that? So again, now we're going back to the IBM stock. We have the one we had earlier, the strike of 50 has a price of $3. The put with a strike of 50 has a price of $2. Fine. So we buy one of each. Now, this position, I'll mention right up front, unlike the others we've seen where we're buying one and selling the other, this one is going to be very expensive because we're buying two different options. So keep that in mind when you see the results. So first, here's the table showing that just the payoffs. Remember, we own a put and a call, both with a strike of 50. And you can see that for the call, we're in the money down here, out of the money down here. We're both at the money at 50. And then on top here, we're out of the money with the call and in the money with the put. So basically, except for 50 itself, at every single stock price, one of the options is in the money. So don't be too shocked when you see the graph of just the payoffs. Oh my God, it's a big V. And so at 50, we have a payoff of 0. Everywhere else, the payoff is positive. Wow. Now, if you notice, this position will benefit when either the stock goes up significantly or down. So in a way, it resembles closely the reverse butterfly. Except, now here's the key difference. With the reverse butterfly, there's a limit to our gains and our losses. Here, there's no limit to our gains, but there is a limit to our losses. Now, once you take into account the expensive price of this position, though, this is what we end up with. So the issue here with the here's the two break-even prices, by the way, 45 and 55. The issue with the straddle is that while there's no upward limit on our profits, it is going to take a significant movement of the stock to break through either the upper or the lower break-even points. In other words, we have to move either at least $5 up or down before we start making money. So that's really kind of the trade-off here. It's an expensive position to start with, and because of that, there's going to need to be a very significant movement in the stock price in order for us to make money. So when you set this thing up, you are counting on a lot of volatility. But if it happens, then there's no limit to how much money you can make. So the butterflies, reverse butterfly, there's a limit to how much you can make, but it's not as hard for your position to move into the money. Okay. So this is our straddle. So now, if you have the opposite outlook, you can set up a reverse straddle where you sell both options. And that puts a lot of money in your pocket today. This is what it would look like. The problem with that one, though, is that unlike the butterfly spread, which has a maximum loss, this one has no maximum loss. Look at that, no maximum loss. It can go down forever. So while you're putting a lot of money in your pocket, your gains are capped at that amount that you've collected for these premiums, and there's no limit to how much you could lose. So you better mean in business when you set one of these up, you must be seriously convinced that the stock price will stay within this range from 45 to 55. Otherwise, you would probably be better off with a butterfly spread. Now, a triangle is essentially the same thing, except that the call and the put have two different strike prices. The call will have the higher strike, the put will have the lower strike. So this is what ends up happening. Yeah, it looks like those coffee filters you can buy where it has a flat bottom. That's what it reminds me of, those flat bottom coffee filters. So what's separating this from the straddle is that it's cheaper, but it's also harder to make money, meaning that you have to move even further up or down in order to make a profit. So in exchange for a limit, a cheaper position rather, you have to expect that now either the stock price has to move up higher or down lower in order for you to make money. So here you can choose the strike prices, and you can have a position where it takes a lot of movement to make money, or little, or anything in between. But the basic position is the same. You're still betting on volatility. Now, of course, you can, like this is what I wanted to see, that the one on the right is very inexpensive because look how far you have to move to make money. The one on the left is cheaper, more expensive, but it's easier to make money. And then, of course, we have a reverse triangle where you just flip everything upside down. You're selling the call and the put, and this is what your position looks like. Now, let's go back and revisit the straddle for a second. If you notice the way it's set up, you really and truly don't know if the price of the stock is going up or down. You don't know. So you're setting a position that will benefit equally from a higher stock price or lower stock price, as long as it's a sufficient amount. But what if that's not the case? What if your outlook is a little different? Suppose that you're pretty sure that the price of a stock could go either up or down, but it's more likely to go up. Okay, so in other words, you're convinced that the price is going to move a great deal, but it's more likely to go up than down. Like with that example with the FDA, you're convinced that the FDA is more likely to approve the drug than not approve the drug for this pharmaceutical company. What you can do then is you can set up a position where you're buying instead of a call and a put, you're buying two calls and one put. Again, with the same strike price, the same asset, the same maturity. So what does that
You have it
accomplish?
reversed.
Oh, did
You
I
have it
draw the wrong one?
You have it reversed in this slide. One call and two puts.
Oh, I better double check this. Oh yeah, you're right. I said it backwards. You're right. Thank you. It looks like I jumped ahead here. This is, yes, you're absolutely right. You're buying one call and two puts. So that means you think the FDA is more likely to not approve the drug than approve it, because on this side, you notice the slope is equal to 1. On this side, the slope is equal to -2. So that means on the upside, every $1 increase in the stock price adds $1 to your payoff. On the downside, every $1 decrease in the stock price adds $2 to your payoff. Okay, so it's 2-to-1 instead of 1-to-1. But as you can probably imagine, if you thought the straddle was expensive, just think how much this one must be costing. So when we take that into account in the next graph, you'll see that, wow, we really have to have a lot of movement in order to make money here. So with all of these types of combinations, the trade-off is between how much you're willing to pay for your position and how far does the stock have to move before you start making money. All right. But again, here, unlike with the straddle, here you're more pessimistic than optimistic, let's say. And of course, there's a reverse strip where you sell all three options and you flip the graph upside down. With a strap, yeah, you're right. This is the one with 2 calls and a put. This is the one where you're more optimistic than pessimistic. So you're buying 2 calls and buying 1 put. So now the slope on the upside is 2, meaning that every $1 increase in the stock price adds $2 to your payoff. Down here, the slope is -1, meaning that as stock price goes down by $1, you're making $1. But again, it's very, very expensive. And you can see, wow, you really need a lot of movement to make money here. But having said that, there's a maximum loss and there's no maximum gain. And of course, there's also a reverse strap where everything is sold, and that means you'll make money as long as the stock price is stable. Now, finally, we've got these last two where we're basically combining a single option with the underlying stock in this case. And so the first one is called the covered call, and the second one is known as the protected put. So the covered call, you own or you buy the stock, and then you sell a call. You own the stock, or you buy it if you don't already own it. And then you sell a call. Now, of course, selling the call means you're collecting the premium, but then what happens is if the price goes up, the stock will probably be called away. In other words, the owner of the call will exercise the right to buy your stock for the strike price, which is what you don't want to happen. So let's again use the example of the IBM call with a strike of 50. September 1st is maturity date. The price is $3. Let's say the stock price itself is selling for $50. And so this is what you're going to end up with. You've got your stock here. And so the payoff is here. Now, you notice it's negative because I've sold the call. I'll just make a note here. The strike is 50. So if you notice, because we assume that we bought the stock for 50, if the stock is at 46, we lost $4 from the stock. We had no payoff of any kind from the option. So the next, all the way down here, the option is out of the money, at the money, and in the money. So when you combine it, now you notice this is kind of strange. You got all zeros and then all negatives. What's going on here? But by the way, this is what it looks like before you take into account the call premium. Now, keep in mind, you are collecting the call premium. So what this means is that you are essentially saying, listen, I don't want to sell my stock, but I'm getting very pessimistic about its future prospects. In particular, I really don't expect the price to go above 50 anytime soon. So what I'm doing is setting up a position where I'll collect $1, and if the option is not exercised, I get to keep the $1. If the option is exercised, I'll end up with $50 because that's how much the strike price is. So you're basically being pessimistic about your stock and putting your money in your pocket at the same time. So I don't know. I'm personally not sure that this is such a smart strategy, but you can see why you might want to do this because you're putting money in your pocket, and you're hoping that you're right that the price will not go up too much. But even if it is, you'll at least collect the $50 when the option is exercised. Now, the protective put, on the other hand, this to me makes a lot of sense, because what you're doing is you're buying the stock, or you already own the stock, and then you're buying a put. And you'll see that by doing this, the put becomes an insurance policy against losses to the stock. Because what's happening now is that if the price of the stock goes up, you continue to gain as the stock price goes up. You have not given up any upside potential, but you do lose the premium that you paid for the put. On the other hand, if the stock price falls below the strike price of the stock, that sets a limit to how much you can lose. So in other words, if you look at this graph for a second, including the premium, this is your new position. So here's the strike of 50. If the price of the stock goes up, you will collect your benefit from that, although after paying $1 for the premium. On the other hand, if the stock price falls below 50, even if it goes all the way down to 0, you'll never lose more than $2. Okay, so this is why you can think of it as an insurance policy. If your stock price changes, you still benefit when it goes up, but when it goes down, there's a limit to how much you can lose, which is $2. So that's why I think of it as an insurance policy on the stock. And you do see a lot of that in the market. These protective puts are very important, because you might own a stock and you don't want to sell it, but you're getting into a rough period. Let's say the CEO just resigned or something, and you don't want the price to go down too much. You can buy a put and then ride out the storm. And then when everything is settled again, you still have your stock. And if the price plunged, then you still will lose a maximum of $2. All right.
What,
so I
what
did
price
put
should
together-
you buy? What price? At what price should you buy a protective put? It should be higher than your existing share price.
Oh, it's not going to be anywhere near that expensive compared to the stock. Like here, if you notice, the strike is 50. We're assuming that the current stock price is 52, by the way, but the
Okay.
premium on the put is only $2. Now, that doesn't mean you couldn't buy. I mean, you have a choice which strike price to buy. If, for example, you choose to buy a strike of 51, then what's going to happen is your position will be cheaper, but you're more likely to lose money. Okay. So there's always a trade-off whenever you set up one of these positions.
Right. But as the stock if the stock loses money, it goes down in price, your option gains in price, so it's offset.
That's right. That's exactly. Whenever you see a flat region in these graphs, that's because two things are offsetting each other.
Right.
At least two
Okay.
things. All right. So just in case this is all very confusing, I put these little tables here, and basically it just summarizes what each of these means in case you want to use them for reference. Like, so when we go to your spreadsheet here, yes, here it is. So, well, actually, I've labeled all the headers, I hope, in a good way that you can see what you're supposed to do. And oh, and by the way, when you see like this column here, bull spread, what you're supposed to do here is put the profits from both of these individuals options, add them up and put them in column L, so that you're actually graphing the net position. Okay. In other words, you don't want to graph these individually because it'll be hard to see what's going on. What you should do is fill out the profits and losses to the first call that you're buying and the second one that you're selling, and then add them together in this column so that when you're done, the graph just reflects the net position. Okay, you'll see that it looks a lot nicer that way. You could, in principle, do each of these individually, but then it's going to be very difficult to see what the net position is. There'll be lines going all over the place. So that's what I recommend you do. This last column L is meant to be the total of all the options positions consolidated into one column. So like here for the butterfly spread, you've got to combine the low strike that you buy, the high strike that you buy, and then the two that you sold down here will give you your net position for your butterfly spread. And you'll know right away if you've done it right, if the graph looks like what we did in the slides. You'll know right away if it look, I mean, let's say if it, you'll see it right away if the graph doesn't look right. Okay, so remember, it's easy to do this, but if you want to do a graph with the way this is set up, you're gonna have to use non-consecutive columns. So remember, on the PC, I'm holding down the control key here. I think it's the command key on the Mac. And that way you'll see you've got two non-consecutive columns, and then you can graph anything you want. You can go up here for insert, recommended charts, and then, oh, yeah, no wonder it's acting like that. There's no numbers in there. Let's go back to this one. Yeah, so this is how I got this one. Select this one, because that's the horizontal axis. And then you'll have control, select this one. This is the vertical axis. And then you'll say, please give me a chart. I mean, you could pick one, or there's a couple that make sense, but I like this one the best. And voila, there's your graph. And you can see it looks just like the ones in the slides. In fact, the ones in the slides were done exactly like this. They're all taken from Excel. So does that look very doable? Yeah. So, and also, if you're not that familiar with Excel, once you have the formula set up, you may be aware of this. I don't have to type that more than once because it'll be the same for every one of these rows. So I just literally drag it down. So you really only need to do the formula once within each column, and then you can drag it down and fill in the rest. So this looks like it's going to be a nightmare, but you'll see, you'll be done very quickly. And then when you're done, you'll be an expert. You'll know exactly how they're all set up and what the purpose of each one is. So does that cover all the possibilities for trading strategies? No, we just barely scratched the surface, but these are some of the more commonly used ones. So I think you'll agree this is pretty interesting. Also, you'll agree that, this kind of thing could not be done with forwards and futures because they're linear instruments and there's a limit to how much you can do with them. Whereas here, the sky's the limit. All right. So how does that sound? You're all here. And I made sure, yes, you were right. The template was missing, but it's there now. So since you were able to download it last week, I guess there's no need to email it to you separately. Although if you do write to me and ask for, I mean, I can still send it to you, but I guess it's not really necessary. So if you look in Brightspace, you'll see, oh God, where is it? It's here somewhere. It's here. Don't worry, it's there somewhere. And now this, what you're seeing here, this is something we'll see again later on in the course. When we start calculating prices for options, we start by trying to understand what factors determine the price of an option. And this is certainly one of them, the time value of the option. What we would like to be able to do is come up with a model price for this option based on all of its key features. And so we'll be doing that in Excel way down the road a bit, maybe not way down, maybe in 2 weeks, let's say. So I think you'll find this to be another extremely interesting facet of options, the pricing part of it. Anyway, so we're just about done here. Does anyone have any last minute questions? All right, good. Then I guess I'll just see you all next week. And keep in mind, we're going to be doing options, not to the very last class, but at least for 3 or 4 weeks, because it's such an important topic and it's so deep, let's say. So let's see, what is next week anyway? Let me just take a look. I think we're going to be looking at some theoretical relationships between options and their factors. There's a lot of interesting material coming up. So, all right, I guess I'll see you all next week then.
Thank
Okay,
you.
good
Have a great
night.
weekend.
All right,
Thank you.
bye.
Bye.
Okay, see you later.